How's it going, everyone? What are covered call ETFs? In this video, we will walk away understanding what covered calls are and their inherent strategy. Covered call ETFs with their super high dividend yields are all the rage right now, like mullets back in the late 80s or hairy legs in today's trends. I'm talking about Global X S&P 500 covered call ETF, JP Morgan Equity Premium Income ETF, and so forth. They're very popular, and as such, you're trying to understand their strategy and be knowledgeable as to what exactly covered call options are. To do that, we must answer the question, what are call options? And no, call options are not when you get someone's phone number at the bar and they have the option to tap ignore on you whenever you call them. If this happens frequently, you might have a face that's made for podcasts, or you were given a fake number. Deal with it, my friend. We will be using Apple as an example, where the iPhone has been the exact same thing for the past 5 years, yet people upgrade every single year because of how powerful their influence is and how an iPhone is a status symbol to the people. But you know what? I'm a hypocrite because I'm in the market for a new phone, and my next phone will most likely be an iPhone. I still think it's criminal to charge $800 for a phone that has a 60 Hz display in 2024. Alright, so here's the most simple explanation of what call options are. Let's say that Apple stock is currently trading for about $100 a share, and you purchase the option to buy Apple stock for $110 a share. That option will cost you $1, and you have a timeline of 30 days. Now, this is contingent upon the stock market acting rationally and Apple stock actually going up in valuation from $100 to a number above $110. Why above? Because would you want to buy Apple stock for $110 a share when it's actually trading for $105? No, right? You can get a better deal on the market if you can just buy for $105. So you need Apple's stock price to be above $110 so you can buy it for a discount with your option contract. So let's say Apple posts an amazing quarterly earnings. Everybody and their ex-girlfriend decides to buy an iPhone, and their stock price jumps up to $130 a share. If this actually happens, then you have the option to buy Apple stock at $130 for only $110 by exercising your call option that costs you $1 per share. Now, when you exercise your options, you can sell the stock on the spot and get the sweet gains. So to get the math in here, you would get a gain of $20 per share minus $1 for the option, which spits out a total of $19 of gains per share. Or you can choose to sell the options contract itself to keep the stock, which would make your cost basis $110 a share with a $20 gain since the stock is trading for $130. Maybe we went too fast and we lost some of you. Let me explain and go into details. For you to make a profit, Apple's current stock price in 30 days must go from $100 to a number above $110. Anything in between and your call options will expire. Expire, meaning that the dollar option contract fee per share that you purchased from your brokerage is non-refundable and you've lost. You lost the bet, the gamble, whatever you want to call it. My pronouns are he and him. Thank you. And I hear you. You're probably thinking to yourself, well, what happens if Apple's stock price actually goes down to, let's say, $90 within the same 30 days? Then you're going to be losing more hair on your head than you anticipated. Well, no. Actually, if that happens, then your brokerage gains $1 per share because your call options expire worthless. The stock price did not reach $110 within the 30 days. The same is true if Apple stock just trades sideways and stays flat at $100. In that case, you also lose $1 per share and you lost the gamble. And before we move on to covered call options, we have to make sure you really get the idea of call options. So in this same example, because you had the option to buy Apple stock at $110, that is your strike price. Your break-even price is $111 due to that contract fee of $1. So to make a profit from your call option, Apple needs to at least hit $112 a share. And depending on the timeline, you can make an action anytime within that duration. In our example, that was 30 days. And something that I want to call out is for options contracts, there's a minimum of 100 share increments. So if you buy one call option contract, like in this Apple example, then you're buying the option to purchase 100 shares of Apple at $110 each. So if Apple stock tanks, then your consequence is a fee of $100. Since remember, it's $1 per share. share. Hopefully this makes sense. I tried to make it as simple as possible, and if you're anything like me, my least favorite subject growing up was mathematics, which is an irony because since kindergarten, I was forced to attend the honors and gifted and talented math program, and I absolutely hated it as a kid. But over time, now I can say that I actually genuinely love math. Funny how the world works. Sometimes you prefer your burger with extra pickles, other times you prefer a fried egg as a burger topping. Sometimes you shake it once, and on Tuesdays you shake it twice. So now that you understand call options, what is a covered call option? It's when you buy a stock and then sell the call option to someone else. So using the same example of Apple stock trading for $100 in the current moment, you can sell the option to someone else to buy Apple's stock from you if it hits $110 in the next 30 days. To give someone that option, you wouldn't just do it for free, right? So you charge them $1 per share as an option contract fee. And how much you charge them depends on the volatility, the strike price, and the timeline. Now, after 30 days, if Apple's stock price stays flat or goes down, then you win because the person who bought the call options from you would lose the gamble and they already paid you $1 per share and their contract expired worthless. And this is important, so please pay attention. Since you bought the actual stock, you also pocket the dividends throughout the year that they pay out. So if the light bulb is going off in your head, you get money from the call option contracts, but you also get dividends. Not a bad deal. And you don't just do this once a year. You do it every week with various timelines to see the true benefits of a covered call option. So why do investors love covered calls? As I just alluded to, it's a form of steady cash flow income into a portfolio. It's kind of like dividends, except it's not passive income. It takes active work to figure out and forecast how a stock price will perform. If you get $1 from the call option contract and you paid $100 to own an Apple share, then your self-made dividend yield is 1%. And that 1% is from that $1 call option contract premium that you charged. However, if we annualize that 1% made in 30 days, then it's essentially a 12% yield in 1 year. Now, let's say you bought Apple for $100 and you sell a call option for a strike price of $110 with a contract option price of $1. And let's just say in a matter of 4 weeks, the stock price of Apple goes up to $120. So the buyer exercises their option. If they do that, then you walk away with 11% gain in about 30 days. You make $10 from the share appreciation gain when the stock went from $100 to $110 and $1 for the call option contract. If you annualize this 11% gain, then you're looking at a 132% rate of return payout. It's crazy money when it works. So let's talk about the strategy behind these covered call ETFs. So what the covered call ETFs do is that they buy the companies in their proposed index, then sell the call options at various strike prices and timelines. And they do this on a massive scale. We're not just talking about 100 shares, but think with me, 10,000 shares of a certain company. For example, this would look like 100 call option contracts because remember, each contract is for 100 shares. And that's a lot of money when you think about it. So the premiums these portfolios make are given out as dividends to those invested in the ETF. And more often than not, they spread out their payouts to be on a weekly basis. So for example, they would sell Microsoft call options that are 30 days out for week 1 and Apple's for week 2 and then Home Depot's for week 3. They do this so that the ETF will always have a stable stream of premiums flowing in. And that's how they're able to pay a monthly dividend. And what makes the ETFs different from one another are the indexes that they follow, but also the strike prices and timelines they choose to follow. The ETFs can be conservative or aggressive so they can cook up higher premiums from the call options. And depending on the fund managers running the show and their financial models, the ETFs will have different tastes and desires as to which stocks to pursue these call options are. Some prefer the thick ones. The other fund managers prefer the skinny ones. It depends. So in short, if you get this sentence, then you understand the entire video. Covered call ETFs are able to pay juicy dividends on a monthly basis from collecting call option contract fees known as premiums, and from when the buyers exercise their contracts from distributing the gains the ETFs profit with from share appreciation. Now that you understand covered calls, you should watch my video on comparing comparing the most popular covered call ETFs against each other to see which ones were good or bad. Or you can just order Domino's for dinner tonight. Doesn't that sound lovely? Anyways, Dividend Compounders with Cheese signing off. Stay safe, folks. I'll talk to you next time.